I want to echo everyone else's thanks for being here, and thanks for our panel, too. This has been a great session, so it's really an honor to be up here with you all. So I have a short amount of time to cover an enormous amount of material, so I will do my best. I will say that we do have a booth outside talking about some of this, and then also the full paper is on the website, so those are available to you. The intent of this project was to get a sense of so how do people use financial advice to make financial decisions in a variety of contexts. And we're defining advice in a very broad way. So I'm not talking about purely the portfolio manager kind of advice or the investment advisor kind of advice, but all kinds of financial decision advice that people get. So we tried to come up with some kind of framework to think about how advice fits into overall financial capacity building, and then what role advice plays, and really looking through the literature about what evaluation or quasi-evaluation has become down out there. And finally, a little bit of data analysis just about who takes up advice. Because if you think about, if the role of advice is to become the backstop or the complement when people have low functional levels of financial literacy, then we might really worry about having a good, robust financial advice market so that could fill in those gaps. And we actually find the opposite. So a little bit of literature review, some framework, and I'll talk a little bit about all this. So this is the first thing is the framework. I think one of the important things we have to do in this field is start to unpack what it is we mean by financial literacy, what are the different interventions. And so this is a very crude attempt to do that. I don't claim this is the end-all model. But you can kind of think about the world in financial capacity building as being three groups. There's information models, things like disclosure, and I'm going to teach you in a one-on-one or a group setting. So there's this clearly sort of information being dumped into your head. On the other end, you have these mechanism models. So these are things like defaults and automatic enrollment, and these are things where you don't have to think at all. We're just going to sort of set you up to hopefully take the right path. And in between, I think you can think about these advice models. So you might know a little bit of something. You might be in a system where there's some mechanisms to track you in the right place, but you still need some advice. You're still at a decision point, and you need some advice. And we've broken this down into 4 categories, and actually the 4th category is a weak one at best. But the first is what we call a technical expert. This is somebody who knows a lot. So I'm not an attorney, but if I have a legal question, I'm probably going to go to attorney, right? Because it would take me a lot of time and energy to acquire the skills that the attorney has. And they've done this thousands of times. They can pretty quickly tell me the answer that I need. So there's this sort of technical expert, typically are credentialed. What's important about these credentialed technical experts is that there are very few of these in the financial market. Most of them are what we call transactional guides. So most of the folks out there who look and appear to have credentialed technical expertise actually have some financial stake in the decision that you ultimately make. Now, whether that matters or not, I think, is an open question. But many cases, the financial advice you get has the potential to be tainted by the fact that the choice you make puts more money in that advisor's pocket. So there's that piece there. Then we have this whole rubric of advice we call counseling, financial counseling. There's a million varieties of this, very heterogeneous. But I would classify this as sort of acute problem solving. So these are people who present with a particular problem, typically a negative issue, going into bankruptcy, foreclosure, default, these kinds of things, where there's a particular kind of thing. The last category, and this could be its own, in fact, we do a whole day-long training on this, is coaching. And so coaching is a little different because it's not necessarily advice. It's more about adherence to whatever your goals are. And so it's more of a self-control mechanism than advice particularly. But it's come up enough that we also covered it in this paper. So the technical experts. Technical experts tend to have a very narrow expertise, and they gain their expertise because they do the same thing over and over and over again. And there are examples of these pure advice givers out there in the market, but they are few and far between. We looked in just a few states, like in Wisconsin, we think we found like 4 or 5 people. And what you have more often are people who do some pure advice, but then a bunch of their business is more compensation, fee-based compensation stuff. So often credentialed and very costly. So if you're talking about people with low financial literacy and you think that's correlated with income or ability to pay, then they may be sort of locked out of this market. The theory about why we have these technical experts, I think there's sort of 2 interesting areas to think about. Sort of the classic reason in economics is that there's a marginal cost of information and they lower your marginal cost of information, which is, sort of near here there. But the next thing is that we make mistakes. So there are clearly lots of examples in behavioral economics of we have biases and make mistakes. We don't recognize that because we don't realize our mistakes until retirement. So we just lived an entire lifetime making mistakes, and it's not a repeated game. I don't get to live my well, as far as we know, I don't get to live my life again. So at least with not the prior knowledge of the prior life. So it's very difficult to make these kinds of choices. A financial advisor gets to see thousands of me, so he gets to see that repeated game and can teach me those lessons. The second or the third piece of this, and I would argue this might be the more powerful one, is more affective. I get nervous. I get anxious. I need somebody to hold my hand to help me not jump when I feel like jumping. And that may be the more important piece in the end. There's also some literature to suggest that it's about spousal relationships. My wife and I cannot get along about money. We need a third-party mediator to get through this. So there may be an important role there, too. Now, if I were to go to a bunch of financial planners and talk about this, they would probably say, oh, yeah, we do a lot of this. It's more on the affective side. But certainly among people in finance, it wouldn't be their first thought. I think what the literature mostly tells us is that mostly what financial advisors do is provide a service. There's a paper that actually uses this title. They're babysitting people's money. I don't always have the time and energy to deal with my kids, so sometimes I pay somebody else to deal with my kids. Right? I always have time and energy to deal with my money, so sometimes I pay somebody else to deal with my money. It's just not something that's high in my utility function, so I prefer to pay somebody else to do it. I think the empirical evidence of the effect of advisors is very mixed. We've never really randomly assigned people to advisors, and what we get is strong selection effects. Most of the studies find, in terms of investment performance, if you were to actually factor in the cost of the advice, it actually lowers the overall performance. Now, that may be a useful trade-off because I don't have the time and patience to deal with my money, just like I don't have time and patience to deal with my kids. So somebody out of my pocket to deal with that, it's fine. I'm paying for a service even though it lowers my returns. That may be a choice I make. So it's a very mixed literature. It mostly is studies that have taken place in Europe. So we actually don't have great evidence of this, but the evidence we do have suggests not strong effects. Okay, so transactional agents are the next category, and the big worry here is this idea of this principal agent problem, where essentially I only go through these transactions infrequently, so I don't know enough to know whether I'm being taken or not. So I follow the advice of somebody who's basically gonna fleece me. And so we have these ideas about fiduciary duty, so that's been a lot of discussion of that with Dodd-Frank, as well as self-regulation. And actually, what most of this research shows is that these problems aren't as big as we might think, because for most transactional agents, they want your business again. So they might fleece you a little bit, but they're not going to fleece you so much that you don't come back for the next round, right? So we don't see. There's certainly a potential in theory for great bias, but we don't see great examples of this happening. And there have been some studies where they compared people with fiduciary duty versus voluntary and blah, blah, blah. And we just don't see big effects there. It's certainly something to be concerned about. I think the mortgage brokerage market in the last few years, we certainly saw some examples, at least anecdotally, of where this was an issue. But in the financial markets, less so. So again, I think this idea that these financial advisors or transactional agents are always going to be in the worst interest of consumers isn't necessarily true. And there's also some evidence that the sort of fee-only pricing might not be great either. So it's sort of a mixed story in terms of how this works. I certainly think there's lots of cause for concern and some hand-wringing about this stuff. Financial counseling, again, I would classify this more as acute problem solving. This tends to be more basic financial issues. So this is not portfolio choice or diversification kinds of issues. This is, I'm about to lose my house. I have more credit than I can manage. I need to work with my creditors on my debt management plan. Oftentimes it's an intervention kind of role. Somebody is at a crisis point, and that's when they step in. A strong nonprofit role here in terms of the counseling world, and much of it is subsidized through, particularly in the mortgage market right now, or in the housing market through HUD, but other markets as well. Usually, these nonprofits are not compensated by pushing products, although I think we could argue, at least in the world of consumer credit counseling and the debt management world, they certainly had some incentive to get people into debt management plans. But it's less of that sort of transactional agent than you saw in these other markets. And because of the public subsidy, that certainly changes the dynamic a little bit. We don't have a lot of theory about why counseling works. There's lots of theory in social work or in psychology about counseling, but less so in the financial world. We do have some evidence that counseling might work. There's a paper I've done, Sumit Agarwal has done, a few other people have done, particularly in the context of foreclosure, which we're all studying now. There may be some value for counseling, particularly because people are under a lot of stress, a lot of emotional issues, very technical kinds of things. It involves coordination among multiple parties, and that's where the counseling really comes in. But it's more than counseling. What I just described is a case management kind of function as well. So we don't have a lot of experiments, and we have lots of indigeneity issues. The selection is strong. Negative selection in this case. People who come into counseling tend to be the worst cases. They couldn't figure it out on their own. So coaching, I don't have a lot of time to talk about. But financial coaching financial coaches don't have to be advisors of any kind. They don't have to have any technical expertise. What they're there to do is hold you accountable for whatever it is you said you wanted to do. So it's not that much different than the reminders we heard about yesterday, the text messages reminders. It's just that you have a physical person who's calling you and saying, you said you were going to create a budget and save $100 a week. Have you done that this week? So it's that kind of role. It's very much a behavioral model. It's a self-constraint model, but I don't have the self-constraint, so I need an external person to come in and provide that external constraint, that person sitting on my shoulder. It's very much about adherence to goals and that self-actualization. We actually have very few examples of financial coaching. It began primarily in the dot-com boom when financial planners were seeing these people who came in with these huge asset levels and were blowing it, and really needed somebody to hold their hand and say, no, you can't do this, and to give them to play that parental role. And that has creeped its way now into more of the low-income and nonprofit arena. Particularly Annie Casey Foundation has been a big promoter of that method. We don't have any evidence that coaching is necessarily better than any other method, but there is some evidence in the health area that suggests that these, health coaches can help people adhere to whatever their protocol was for diabetes or health or whatever else. So I think that this idea of adherence, goal setting and adherence, is probably something that deserves more attention. Okay, so just to sum up where we're at on the literature review, and then I'll just spend a minute on what the data shows us. There definitely seems to be a good rationale for the technical expert, but there's very few examples of a pure technical expert that you can pay for. And what value is it? Is it more of an emotional tool? Is it a babysitter tool, or is it actually to fill in my financial literacy gap? And that's not entirely clear. The transactional role is primarily what advisors are. That fiduciary duty is something to think about, but I'm not sure that the evidence suggests that it's a big deal. The counseling, as I talked about, is more basic financial management and crisis focused. Okay, so take-up of financial advice. This is a number of different surveys that shows take-up of advice around investing and financial planning, and then about loans and debt. You see it's all over the place. We don't have good measures of how many people are actually doing financial advice. So we use the FINRA Financial Capacity Survey. And so here's just any advice. So the FINRA survey asked about loan advice, investment advice, tax advice, different kinds of advice. So any kind of advice by income, and you can see the pattern. Higher income, more likely to take up advice. At the highest income levels, almost 2 out of 3 people, or more than 2 out of 3 people did it. At the low income levels, less than 40%. Education level, same story. More education, more likely to take up advice. So this is kind of contrary to the model of advice being a complement to financial literacy, right? Because if you think these are the correlations of financial literacy, it seems like the people who are most financially literate, most well off, are the most likely to get advice. We did some regression models to try to model this as well. We find that males are less likely to take some kinds of advice. Across the board, higher income, more likely to take advice of all kinds, all across the board. Education, at least in a couple of categories, more likely to take up advice, non-significant in other categories. Race had some mixed effects. There was a financial literacy score in the FINRA Financial Capacity Survey. Across the board, more financially literate, more likely to take up advice. So it's much more of a complementary role as opposed to a substitution kind of role. People who had an income drop, however, were more likely to seek financial advice. So it does sort of say this trigger event piece is really important, and some mixed effects on being a homeowner. We have some questions also, too, about attitudes toward financial advisor to try to figure out if some of this was about attitude or perception of what the advisor's role might be. I wouldn't make too much of these effects. They were kind of mixed. But clearly it's more than just perceived value. It's also perceived cost and how they shop for advisors and how much trust they had. So I think in the end, again, this was a literature review as part of our sort of foundational piece this year to think about big pictures and bigger research questions. Advice models have potential. It is not a clean and easy solution, though, to financial literacy problems. We came up with this proposed framework. I would say it's crude, but hopefully it helps us sort of think more precisely about what we mean in this field about these kinds of things. The empirical evidence is really lacking. I think this is a charge to researchers to begin to think about more rigorous ways to really look at these kinds of models. And I think that the babysitter model or the other kinds of models are interesting, and we don't necessarily think that they're negative. Sort of these emotional and other kinds of roles are important to think about. So we can talk more about this in discussion, but I think there's probably lots of fodder here for both practitioner, policy, and research work in the future. So thanks very much.